What is going on, my fellow income investors? Welcome to my channel. I am the covered call guy, and for those who are new, welcome. My goal here on this channel is to create $120,000 in annual passive income. Currently have 7 holdings, more to come, more to add. Right now I am holding GPIX, QDIVO, GPIQ, IWMI, SPY-I, QQI, and IDVO. With those 7 current holdings, it gives me about 70 grand a year, about 5.8k a month, 1.3k a week, $193 per day, and about $8.05 per hour. All right, legal disclaimer before we start. This content is purely for entertainment and educational purpose only, not investment, financial, or tax advice. I am not licensed, certified, qualified, or caffeinated enough for all of that, okay? All my BS is my opinion. I may be wrong. I may be misguided, straight up nonsense. All right, do your own due diligence, do your own homework, and talk to a real professional before making any money moves. Remember, I'm just a random stranger on YouTube, and I could be completely wrong. All right, now with that out the way, I'm gonna be talking about a hot topic, or a hot topic as in a lot of you guys love CEFs and BDCs, and myself too. All right. But I want you guys to understand, to understand the difference between the two, what they are, and understand how to pick it, right? You got to be able to cut through the hype. So for those who are new into income investing, right, CEFs or closed-end funds. So think of them as flexible income vehicles that can hold bonds, equities, loans, option strategies, a whole bunch of stuff, right? BDCs or business development companies, okay? These are direct lenders to private companies, okay? Private credit exposure, and maybe you have heard private credit exposure cracking in the news lately, right? So understand what you hold, understand the pros and cons, right? The good and the bad. All right, simply, BDCs typically offer a higher yield, but also comes with a higher credit risk, while closed-end funds offer diversification and strategy flexibility, but comes with a discount / premium risk and leverage complexity. So you do have to buy at a discount, whereas BDCs, you can buy at a premium and you'll still be fine. All right, so the trap of closed-end funds, right? CEFs. Let's get started with CEFs first. All right, so a closed-end fund raises fixed capital and then trades on the stock market, right? Holding things like bonds or dividend stock or whatever they want to hold, right? The beautiful part of this is fund managers don't have to fire sell assets when retail investors panic. Hence, it's closed, right? It's not open. The ugly part is the leverage, right? They do borrow heavy money to blindly juice returns, okay? That is the ugly part of it. By law, they only need about $3 of assets for every $1 of debt. So, this is aggressively amplifies your yield, but also your absolute losses. So understand the pros of this comes with the cons. So now that you understand this, like, do you want to get into CEFs, right? All right, the dark underbelly of BDCs, right? A BDC is basically a publicly traded shadow bank that lends cash to private companies, right? So think of companies who aren't able to get a regular loan. Well, they come to the middleman, right? BDC is what it is a middleman for middle to smaller size businesses or whoever wants to borrow the credit, right? Since traditional banks ran away after 2008 because of the crash, right? BDCs has really stepped in and took a major hold on this, right? Charging a more massive premium for floating rate loans, and then pretty much throwing massive 90% income payouts right at you. So for those who are new, one of my favorite BDCs, if anything, is my only favorite BDC, is Main, ticker symbol MAIN, Main, right? So what's the catch with BDCs, right? You are taking a pure credit default risk here. Again, pause the video and just Google credit default risk BDCs, and you'll see a whole bunch of articles from pretty much recent, right? So a lot of things are cracking. But is it a bad sign? Well, no. If you hold good BDCs, well, then this is a sign for you to load up some more. Perhaps now you can get get in on not paying such a high premium for this, right? So yes, you are taking pure credit default risk from businesses that could easily go bankrupt. All right, so what's the ultimate standoff, okay? The brutal standoff between the two is that CEFs, in my opinion, are engineered for market strategies, while BDCs are pure lending machines, right? So think of pretty much, you can't borrow from Wall Street, so you have to go to Main Street, right? You go from pretty much, the big hedge funds won't bat an eye to you, but the little guys at the corner will go ahead and give you the loan, legalized, right? Not loan sharks here, right? Just think of it that way. They're much more. They're essentially a bank, but not really a bank, right? While BDCs focus entirely on credit risk, while CEFs expose you to portfolio strategy and leverage risk. So, as you can see, CEFs, the structure, investment fund, main activity, portfolio, investing, income sources, engineered returns, right? Coupons and gains. Typical yield is 6 to 12, right? The primary risk is market volatility plus the leverage. While BDCs, the structure is, it's a lending company, main activity, direct lending, income source, right? Pure lending, as you guys can see, it's pretty much almost a bank, but not a bank, right? Interest and fees. All right, typical yield is 8 to 14%, while the primary risk is, again, credit defaults. All right, fake cash and cannibalize capital. So looking at CEF engineering, CEFs engineered the income from bonds, coupons, options, and capital gains, right? So beware of return of capital, right? Something you guys would be very aware of on my channel. I am a cover call guy, right? So return of capital could be good and or it could be bad. So you have to be aware of the destructive rock, right? This is toxic accounting trick where the fund perpetually cannibalize its own net asset values just to pay you. BDC lending economics, right? So BDCs are pure lending machines generating interest and origination fee. Okay, that means you must aggressively watch out for payment in kind, PIK. This is fake cash where borrowers just add interest to their loan balance, okay, because they can't afford to actually pay you. This is where you go, okay, should you get into it because it looks good, or should you get into it just because they're able to fake their balance sheet? You get in, get out. A lot of people do this just because it looks good on the front and the balance sheet looks suspect, but they get in, get paid, and then get out. But this is also part of the trap where they don't get out fast enough, and then pretty much the stock will liquidate itself, and you lose out on both the payment and the NAV. You have to be aware of this. This is why I just stick with one, and that's Main. Hey, the nightmare risk scenario. So looking back at 2008, the crash, right? BDC's multiple plummeted to a catastrophic 32% of the NAV due to a massive liquidity freeze, right? This is where credit freezes up, right? So history does prove that 1 in 3 publicly traded BDCs will brutally cut their dividends during these intense economic strain. And on the flip side of this, CEFs face a deadly leverage death spiral, right? If borrowing cost spikes, so they can be forced to liquidate assets at the exact market bottom just to survive, right? Guaranteeing your distribution gets slashed. We never want this to happen. This channel, right? If you're a regular investor, right? We talk about SORR, sequence of return risk. Never want to sell at the market bottom. You never want to put yourself in that situation where you have to sell. We don't want to sell at all. All right, surviving the market meat grinder. What do I mean by that? Well, let's look at an environment of rising rates, right? When interest rate rises, BDCs win massive windfalls from floating rate loans, while bond-heavy closed-end funds bleed out, okay? Recessions. When a recession hit, BDCs get crushed as loan defaults, right? People can't pay back their loans, right? Making high-quality closed-end funds your only shelter. Bull markets. What happens in a bull market though, right? Equity closed-end funds explode upwards while massive capital gains, massive capital gains, while for the most part BDCs do stay a little bit flat in this scenario. Okay, the taxman and portfolio strategy, right? We always got to talk about the taxes, right? Let's look at the BDC tax trap, okay? For the most part, BDC income is overwhelmingly ordinary income, okay? You pay up towards of 37% here, okay? That means the IRS will absolutely gut you on taxes if you don't hide them in the IRA, if you use the IRA, okay? Use BDC strictly as your high octane yield booster. This is a great yield booster, but never over concentrate here, okay? No matter how high of a quality they are, don't let it be more than like, keep it 5 to 10%. Even 10% is a lot. 5% is great, okay? The CEF Foundation, okay? As much as they offer a better tax engineering by distributing tax exempt municipal income or capital gains, right? Because they are highly tax efficient, you can safely hold them in a tax account as your defensive core. Play CEFs, a good one, pick the right ones as your defensive core. Not saying a core, play it defensively. There's different meanings behind that. Okay, again, never ever buy blindly. What I mean by that, this is what we call the Z score. Okay, if you are experienced, a bit more sophisticated investors, do not buy CEFs blindly. Okay, we use a Z score to strike when everyone is panicking. Okay, the Z score measures exactly how far a closed-end fund's current discount deviates from its historical average. Okay, so this is just the formula. Z equals current discount minus average discount over standard deviation. So buy below a -2 to lock in artificially inflated yield. Okay, this is possible if you want to. Okay, we never want to do sell though, but if you are into that and you just want to lock in some profits, you sell above a 2.0 position to harvest your gains and just rotate out. Okay, so my playbook, if you were into this, right, this is the more conservative scenario. CEFs 60%, tier 1 BDCs 20%, and then dividend ETFs 20%. This is how you can play it. This is what I would consider a conservative side, right? Again, 60% CEFs could be very, very non-conservative, but this is if you're playing only dividend ETF, BDCs, and CEFs only, okay? My conservative portfolio will yield about 6 to 7.5%. And this part could let you sleep a little bit better at night. You are completely insulated from massive corporate defaults while beating standard ETF trash yields. This is where you can't survive off these 1 or 2 percenters, right? The minimal BDC's allocation acts strictly as a surgical yield enhancer. It's just to juice it up. But what if you want a more balanced income, right? And this is where you kind of lower the CEFs to 45, quality BDCs to 30, other assets to 25, right? This is where your balanced portfolio yields roughly 8 to 9.5%, right? And hits absolute sweet spot for serious risk-adjusted cash flow investors, okay? This is the playbook where you're only invested into these three. Some people just want to do these three. This is the balance approach, right? You capture a bit more massive BDC illiquidity premium while keeping enough closed-end fund exposure to catch public market rallies. So you don't really cap yourself here. Okay, but what if you want to go a bit more aggressive? Because a lot of people on this channel, for some whatever reason, do like aggressive high yield. Well, then go for the higher yield BDCs, right? Push it to 45% of your portfolio. Go for leverage CEFs, right? 35%, and then high yield ETFs at 20%, right? This is my more aggressive portfolio yield approach, where now you're hitting 10.5 to 13% plus, right? But it is only should be for the more fearless yield chasers. Again, those who can stomach it, right? You will of course face a more profound NAV volatility and almost certain localized dividend cuts during a recession. Okay, we might be entering a recession right now. We don't know. All right, a lot of signs do point to a recession with a lot of things that's happening right now. So if you're into the aggressive high yield, well, let's see how it plays out. Right, of course you have to actively monitor this or you will get burned, because again, the more aggressive you are, the higher risk it is. So the tier list, best versus trash. Again, this is again my opinion. Okay, Don't go too hard on me on the comments. Tier 1 that lets you sleep at well, I'm gonna say Main boasts an 18-year streak. ADX uses zero leverage, and UTG survived 2008 without cuts. Tier 2, this could be your core, right? ARC, BXSL, CSWC, right? They have a more massive scale and over 100% dividend coverage. Great, love it, excellent. Tier 3 is the danger zone. And this is where you want, PDI that uses an insane 31% leverage, PSEC that has, I'm going to say, toxic fees, and SCM leaves zero margin for safety. Again, higher risk, perhaps a higher reward. I don't know why you would want to touch it, but some people do. Okay, the ultimate monthly income combo, right? Let's look at 50% base. If I were to go down this path, right, you can perfectly smooth your income curve by combining monthly CEFs with staggered quarterly BDCs. Okay, so the 50% base, right? I would go ahead and just allocate 50% base to monthly pairs like Main, UTG, and PDI for predictable cash flow. 25% offset A. This part is offset A, where I offset 25% quarterly BDC chunk, so it triggers in January, April, July, October, and another 25% to offset B, where I offset the final remaining 25% in alternating months like March, June, September, December. And then result, obviously, the rest is a 10% blended yield of pretty much flowing seamlessly every single month without a dry period, right? So this is where you get paid every single month. It's pretty predictable. You can kind of guess your payment. You can go down this route if you want this income combo. All right, that was all. I hope this was informational. I hope it gave you an idea of how to play this. I know a lot of people here do love their BDCs and CEFs. I do myself, but just understand, know what you're picking. I wouldn't go more than 2 closed-end funds and 2 BDCs, just because I do think they're more of a core satellite and kind of just exposure into a different sector, but I wouldn't really go above that. I think 2 closed-end funds and 2 BDCs is enough. That's just my opinion, of course. And if you got something out of this, subscribe, comment, like. Again, stop chasing yields blindly. Weaponize these 2 to build your all-weather income engine. Okay, I love BDCs myself, and I do love closed-end funds, but some people, I do know some people have way too many, and it can get crazy. I'm talking from a position of me just holding covered call ETFs, but understand, I'm still building out and scaling out. When I say I know some people that hold a little too much, as in they're already pretty much retired, right? So they already at that point have all the eggs in one basket. So yeah, thanks for watching. Got you guys the next. Stay tuned.